Interest rate hikes continue to be a hot topic heading into 2022. We have a bank in the US putting a prediction in place based on when they think the Bank of Canada can start raising the rate. Hint, it's coming up relatively soon, so we'll be discussing that. And we've also seen some Canadian banks urge the Bank of Canada to take action sooner rather than later. So we'll be discussing a little bit of the commentary behind that as well. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, I'd like to ask you a huge favor. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. We'll start off to our neighbors in the South. The most prominent bank, in my opinion, is JP Morgan, and they believe that the Bank of Canada is going to hike rates this month. So this came out January 12th, a few days ago, and they say that economists at JP Morgan expect the Bank of Canada to raise its benchmark interest rate at its Jan 26 meeting, and that's ahead of the central bank's own timeline for liftoff. They talk about commentary that was made in December, and that's kind of making them think that they are going to move ahead with an interest rate increase. Now, the increase will probably be about 25 points, which puts us up to 0.5, which is relatively low number. We've talked about where it could end up at the beginning of the year. So if you want to see some of that video, I will link it above. Just to get an understanding of where we're at today, record low interest rates, record high inflation. They're definitely going to need to make a move sooner rather than later. So that's what the expectation is for JP Morgan. So it will be a very important piece when it comes out on January 26th, what the Bank of Canada is going to do. Next, we move on to the four Canadian banks that are urging the Bank of Canada to raise rates, and another is warning home buyers. Obviously, with the interest rates being so low for so long, it's caused money to be cheap. It's relatively cheap to go and get mortgages, go and get lines of credit. That is the biggest worry, and we'll read a little bit more about what each bank is saying. So we have the biggest bank in Canada here. RBC has probably been the one that has been first to come to the scene in terms of making these complaints. So we have RBC CEO David McKay said, "This is permanent, sustained inflation that has to be dealt with through monetary policy. And therefore, we need rapid action this spring with a series of rate increases to address it. Monetary policy is interest rates and how much spending the government is doing. That is controlled by the Bank of Canada." And the executive warned that wage increases aren't transitory. If high inflation drives wages higher, the inflation is now priced in. It can't be transitory. We don't roll back wages, and they can't roll back prices once wages adjust. Higher wages, they sound nice. You get more money, your salary increases, but at the end of the day, if everything else is increasing, your wages are merely increasing to match that as well. That is not a good wage increase. So the result can be wages rising substantially, but not enough to cover the cost of living, reduce consumption, lower future purchasing power, and devalued existing capital. The amount of money that you made today can't get you as much tomorrow, and that is definitely a huge implication. We go on to read a little bit more about what the next bank has to say, and the next one is Bank of Montreal, and the chief economist there is Douglas Porter, and he publicly questioned the central bank's motives starting on October 25th, 2021. Current ultra stimulative policies look far out of step with red-hot housing, record equity markets, decades high inflation, and employment back at pre-pandemic levels. There is no justification for such extreme stimulus at this point. We've done everything we needed to get us through the period of crisis, which was dropping down these interest rates when everybody started losing their jobs. What has happened now is that all of a sudden our wages and the employment level has reached what it was in 2019 or beginning 2020, whatever metric you want to look at. We don't need these record low interest rates, especially with inflation running rampant. Next, we have the National Bank of Canada, and they have arguably been the most critical of the Bank of Canada's policy recently. From the Bank of Canada discrediting its own inflation research, they don't believe what research they've done, to ignoring employment benchmarks it's up for itself. So they said, hey, once we get up to a certain level of employment, we will stop printing so much money. They have not done so yet. So maintaining such a loose policy standing much longer risk compromising Canada's longer-term economic and financial market prospects. We've talked about this many times before. People will potentially become house poor if they take out these big mortgages from buying these big homes. You won't have as much money to spend in discretionary income or investing or looking at tomorrow instead of looking at today. We also have CIBC coming out and saying buying Canadian real estate is risky right now. CIBC isn't calling on the central bank to do anything, but they warned Canadian real estate buyers. I think there is a risk getting into the market at today's rates. We are still dealing with emergency interest rates, and let's remember that these are not normal interest rates and they will eventually rise. An example that has been posted all over the internet is this one right here, and it's a place in Bowmanville, and it was bought in July 2019, 30 months ago, for $794,000. From there, it was sold just last week for $1.6 million. That's an $811,000 increase in 30 months. So 30 months, 50% gain. There is something going wrong here, especially if we look at where this is located. I know I mentioned Bowmanville, but for those that are not in the GTA, we'll take a look at Google Maps here, and we see that this is an hour away from the downtown core. This is not something that is normal. This is something that has definitely been caused by low interest rates. So we go back to take a look at what the next bank has to say, and that's Scotiabank. And they say 8 rate hikes needed to cool inflation. Rate hikes 8. Okay. 8 rate hikes to curb it. I cannot believe what I'm seeing. We still view the supply disruptions as temporary, but they are clearly more persistent, especially with this new truck driver regulations that have come out more recently. If inflation rises more rapidly than we expect, we may need to forecast an earlier tightening along with potentially higher 2023 endpoint. So what we see here is we see banks mentioning all of the effects that low interest rates have had. And we're at the part of the economic cycle where we need to tighten. We need to tighten up money and make sure that the next recession that we have is not even more drowning. We can't print any more money. The interest rates can't get any lower. We're definitely putting ourselves at a very risky point if we don't act soon. So let me know down below. Do you think January 26th, the Bank of Canada is going to come out and raise the interest rate? Or are we going to continue for at least another 3 to 4 months with these record low interest rates? Let me know down below. If you're still here with me, hit that like button. I definitely appreciate that. Thank you all for watching. Have a great week in the markets. Happy trading.